Well, hello everyone, and welcome out to Options Foundation Part 1. In today's class, we want to explore options and make sure that we build a solid foundation to build upon, because as we progress further, we're going to institute strategy and we're going to talk about spreads and combinations. But before we do that, we need to understand the basic principles of options. What is a strike price? When is an option in the money? And that's what we're going to do with this Options Foundation course. So it's a great starting point to make sure that you understand the basics of options and then can build upon that and have a solid foundation to build upon. As always, we want to start these with a reminder that we're going through this without regard for any one person's investment objectives, financial situation, or particular needs. So please don't act upon these recommendations. Run them through your personal trading plan. Make sure that this fits your criteria and your risk tolerance before trading the options market. So we're going to talk about two types of options: calls and puts. Calls, most people are familiar with the idea of buying a call. That's kind of the basic idea, is I can buy a call option and that gives me the right to call away a stock. Now, when you buy a call option, there is a definition that goes with that, and we're going to give you the four basic definitions to options. Now, remember that in the options market, there are only two types of options out there. There's call options and put options, but because we can be a buyer or seller of either one of those, basically you always end up in one of four situations. Buying a call gives you the right, not the obligation, to buy the stock for the strike price amount on or before the expiration date. And that's the definition of it. As we go through strategy, we can plug that definition in to really understand how that buying a call option works in the midst of a spread trade or in the midst of a combination trade. When you sell a call, it's a little different. You can think of it as, well, they could call my stock away. We're taking on an obligation anytime we're selling an option. And so when we're selling a call option, we're obligated to sell the stock for the strike price amount at expiration if the other side of the trade wants to call that stock away from us. And they will want to do that. In fact, shares would be called away automatically if our call option that we sold ends up in the money at expiration, and we'll touch on that point. So I don't want to get too far ahead of us, but just understand that definition right there, the obligation to sell the stock for the strike price on expiration. We'll come back. On puts, we can be a buyer or a seller of the puts. Now, when I buy a put, I can put the stock to someone else. That means I have the right, I'm not obligated to do it, but I have the right to be able to sell the stock for the strike price amount at expiration. If I sell a put, remember, whenever we're option sellers, we have obligations. Whenever we are option buyers, we have rights. As I sell a put, I take on an obligation to buy the stock for the strike price amount at expiration. And again, they're going to put me the stock. They're going to exercise their right if that put option lands in the money at expiration. So let's explore this. I understand that if you're brand new to options, your head's kind of spinning right now and you're thinking, does he really expect me to know what all of that means yet? And the answer is a resounding no. But what I want to show you is these four definitions, and it probably wouldn't be a bad idea for you to pause the video and actually write these definitions down on a sheet of paper, because these are the four definitions that matter most. It's your rights and obligations. So I'm going to explain this over and over again, and we're going to build this solid foundation. But this is all options are in a nutshell. They're just rights and obligations to do something with the stock for the strike price amount at expiration. So let me give a more simplistic example. Let's use real estate as an example. So I have a home, and you'll have to excuse my drawing here. And this home, beautiful home, as you can see. And I maybe I give someone a lease option, a lease and an option to buy that home. So in other words, this home might be worth $200,000. And if this home is worth $200,000, well, maybe this person wants the right to be able to buy it for $200,000. they're going to live in it for a period of time, maybe get the loan at some time in the future. For whatever reason, they don't want to commit to buying it right now. So they agree that they're going to pay me, let's just keep it simple, $1,000 per month with the right for the next year. So 1 year's time. And maybe that's, if it were, let's just say, April this year, well, that'd be until April of next year. If it were December this year, that'd be until December. They have 1 year, and they can exercise their right and buy the home from us for $20,000. They're going to pay us money in the meantime for those rights. That's kind of how the options market works. So if we think about a call option, when you buy a call option, you pay someone money. You pay what we call a premium. So that's the $1,000 you're sending over, right? To lock in a commitment. Maybe that's your rent or however you want to think of it, but you're renting the rights to that stock. You're renting the rights to this home. You're not obligated to buy it. You can walk away from this deal. But if you choose to, you have to pay the strike price amount. That's the agreed upon price at which the transaction will go through, and you have until a certain date in order to do that. So all of these options, calls and puts, they always have a strike price. That's where the deal would be done. That's where the buying and selling of the stock would actually take place if you wanted to turn your option into stock, or someone else, if we sold an option, then they would obligate us to turn the stock, right? To fulfill our commitment, like selling the home or selling our stock. But the point is, there's a strike price. That's the deal price. There's a premium paid. One person pays it, one person collects it. And there's an expiration date. And that's all there is with these options. So when we call options derivatives, we mean just that. Options are derivatives of stock, so their value is derived from the stock. So for call options, if the stock goes up in value, that's kind of like our house example here. If this house were to go up in value over the next year, housing prices are booming like the mid-2000s, and this house goes from $200,000 to now it's appraising for $250,000. Is this person going to exercise their right to buy the home? Yes, they are. And guess what? They get the deal price. They locked in a price at which they could buy the home, and that was $200,000. They don't have to pay the $250,000. So when you buy a call option, you're locking in your price, your striking price for where you get to buy the stock. And if that stock goes up a ton from now till expiration, your call option is going to gain a whole lot of value because it has gained intrinsic value. Just like this home appreciated in value, your stock is going to be moving. And if it's going up, calls are going to be going up in value. On the flip side, puts actually make money if the stock goes down. So, this is kind of a bad example, but you could use insurance to kind of explain a put option. Let's, again, excuse my drawing here. I'm going to draw the most beautiful car you've ever seen, something like this. Well, when we think about insurance, right, and we think about buying a put, it's kind of like buying the rights to something going down in value. So you could essentially bet on this car crashing, or kind of a terrible example, someone dying. Well, you could buy someone's life insurance policy from them, right? That has a big payoff. And basically, you're going to make payments to that person. And you're going to say, I'm going to buy your insurance from you because it has $1 million payoff. I'm going to pay you thousands of dollars or whatever over time. And essentially, if and when they die, you get that larger amount of money. That's kind of how puts work, in that stocks are going up in value sometimes. Stocks are also going down in value sometimes. When you buy a put, you've locked in your sell price. You've locked in a price at which you get to sell the stock. So if you get to sell it up here at the strike price, and that stock in the meantime, since you've bought the put, has gone down, down, down in value, guess what? You still get to sell it way up here. Since that stock is way down here, you've profited immensely. It's gained intrinsic value because the difference between where it's currently valued and where you get to sell it is quite wide, and you get to sell it high. And people right now are buying it low, right? And so in essence, you make money, you can see, as the stock price goes down. And I ask a lot of people, is it easier to find a stock that's going to go up or in value or down in value? And a lot of people say down in value. A lot of bad companies or bad fundamentals, bad market environments, whatever, stocks go down at a faster pace and we can make money from that. So this might sound complex, but trust me when I say we'll take little bites. We'll bite it off just a bite at a time, and we'll make sure that everything is understood. So when you think about single leg option strategies, you can think of them directionally, but they don't always work that way. Meaning, if we just went out and bought a call by itself, then we would be bullish. That's true. But sometimes you're doing a combination. Sometimes you're buying that call as a protective position for a more important option or stock position. And in that case, it's not bullish, it's protective. We don't want to use it, but it's like an insurance policy. But stick with me on this. If you just went out in the market, you had no other positions, and you bought a call on something, then you're bullish, which means you want the stock to go up. If you had no other positions, again, you weren't using this as a hedge or anything, and you bought a put, you would be bearish. You would be wanting that asset to fall, which would increase that, it would cause that put value to rise in value, and you would make money accordingly. On the call side, when you're selling, that changes things. If I sell a call as a naked call, which I don't advocate, and we'll talk about why you want to avoid naked call selling. They have unlimited risk and limited reward, and they're just kind of a dangerous, very, very deep into the pool. But if you did it and you just sold a call without any other position, you would be bearish. If you sell calls, you want the stock to go down. And if you sell puts, naked puts, which make more sense than naked calls, we'll talk about why that is, but selling a naked put is bullish. You want the stock to go up in value. You are bullish on the stock. So if we just think about the options by themselves, buying a call by itself, you're bullish. Buying a put by itself, you're bearish. Selling a call by itself would be bearish. Selling a put by itself would be bullish. Okay? Different directional trades that way. Now, when you place an order in the options market, some brokers don't specify. Some brokers, you just place a buy or a sell order for the option. Other brokers specify, and they'll call it to open or to close. Anytime you're opening a new trade, you're just starting a new investment, it's considered an opening transaction. And so you could buy to open or you could sell to open. And think about why that is. You're opening a brand new trade. So if I own stock of Disney, hypothetically, and so I own shares of Disney, can I go in and sell options to generate income off of my stock? Can I enter into an agreement with someone to sell my Disney shares at a higher price than where they're currently trading? Yes, I can, and I can get paid money for that. That's called a covered call. So I would be going in and I would be selling to open an option contract against my Disney shares. I don't already have that option, in other words. Anytime you don't have the option and you're just getting into it, whether you're buying or selling, it's called an opening transaction. Well, when you're in something, I bet you can guess what it would do to exit that position. You would be what we call to close. It could be sell to close or buy to close. That means you're getting out of something you're already in. So if I bought to open a call option, when it was time to get out, I would sell to close. I would do the opposite. I'm always opening first and closing second. But if I buy to open, then I sell to close to get out. If I had sold to open this Disney covered call and I wanted to buy it back, I would buy it to close. So to open always comes first, to close always comes second. You simply do the opposite of what you did to get in. That's called closing out your trade. It's important to understand that options don't have to be held until expiration. You can get out of options early, and in fact, that's oftentimes how we do it, especially if we were in a strategy where we were buying a trade, where we were buying calls or buying puts or something where we were targeting a directional move. We're almost always going to get out of that trade early before it actually would convert into stock. So we're not really trading options with the goal and the intention of actually taking ownership of the stock. Instead, we're trading the option for the value of the option. So we're buying an option for $2 per contract and hoping to sell it when it's gained a lot of value, maybe when it's worth $3 or $4 per contract. And you can enter and exit these trades. The options market is open during the same time period as the stock market. So it opens at 9:30 a.m. Eastern Time. It closes at 4 o'clock p.m. Eastern Time, just like stocks. Stocks are traded in shares. Options are traded in contracts. Each option contract controls 100 shares of the stock. So when you buy an option, you literally are taking control and ownership over 100 shares of the stock. You have control over that stock for a certain amount of time and at a certain price. Remember that options are traded in contracts. So if we want to trade an option contract, then we're getting control of 100 shares. Well, what if we wanted to control 300 shares of the stock? Then we would trade, of course, 3 option contracts, and that would gain control of those 300 shares. Well, what if we wanted control of 1,000 shares of stock? Then we would trade 10 option contracts, right? Every one contract controls 100 shares. Why do most traders get excited about options? It's the leverage. It's really that potential. That's the reason. And let's say that you have a great setup in a stock and it's trading at $500 per share, which is not uncommon. A lot of stocks are high priced, 200 per share, 300 per share or higher. If you have this setup, you could trade the stock, but 100 shares of the stock at $500 per share is $50,000. So it's a large investment. It's a very high capital requirement. Now you might say, well, I just can't trade that stock. It's too expensive. With options, you could do that, right? So let's say further that you had a certain expectation. You thought that the stock at 500 was going to go to $520 per share, and you're thinking, if I bought 100 shares at 50,000, it goes up to 520, I'd have 52,000. I'd have a nice profit. I have 4% upside in the stock. That's what that $20 gain would be. A $20 gain on a $500 share price is a 4% upside move. We'd make $2,000. That sounds pretty good trading the stock, but darn it, it's so expensive. Maybe you're saying, I just can't justify putting that much money. Even if I have $50,000 to trade, I'm not going to put all my eggs in one basket. Now, if I have $500,000 to trade, $1 million to trade, well, maybe I can trade the stock. But for a lot of people, they're saying, maybe that's out of my price range. With options, you could literally position a trade right around these expectations. You could buy the 500 strike calls and sell the 520 calls. This trade might cost you $5 total. That's $500 to buy this spread trade. And guess what? The beauty of options is that you can position your trade exactly the way you want it. So if you think that the stock's going to 520, you can position that so that it is literally just exactly at 520 where you make your max profit at expiration. So if that stock does get to 520 or higher and it's sitting there at expiration, you're going to have your max gain. and you're going to make your upside. This trade would have $20 of profit potential minus your 5 invested, so you'd have $1,500 of potential gain. Now you say, well, 1,500 isn't quite the 2,000 that the stock could have made. That's true. There are some specifics, there are some little intricacies of how this works, and we'll talk about that. Why didn't the option make all that the stock did? Well, because of delta and some different things that we'll get to. But the point is, you'd have made most of that money with far less risk and with a lot less capital required. So think about that. It allows you to capture the profit and have less risk for the entire time. We're not investing $50,000. We don't have $50,000 at risk. We only have our $500 we paid for the spread. So we bought the 500 strike call, sold the 520. Trade cost us $500. We have $2,000 of potential gain minus our investment. So we have the potential to make $1,500 on $500 of risk. And you say, well, is risking, is this common? Can we find trades where our potential reward is 3 times our risk? Absolutely. We could go right now and find 3-to-1 reward to risk ratios in basically any stock. Now, you've got to match that up with, okay, what's the probability of success? What's my outlook on the stock? There are some steps that we would go through. We wouldn't just blindly throw on trades, but you can see the power of it. Now, let's take a look at this example in practice, this idea of leverage. So Apple's a good example where it's a high share price. You can see it trading at $178.44 per share. So that's a high share price. It might have been off your radar due to the price, and you say, well, I just can't take advantage of it. And the reality is a lot of the best stocks are the highest price stocks because they got there from price appreciation, from good business practices and building shareholder value and so forth. But as you look at this, you say, okay, I can't trade it if it's the stock perhaps, or I can't trade much of it. With an option, you can now control 100 shares of Apple for a fraction of the cost. Take a look at these options. Here we have options, and this is a 180 strike price. That means we get control of Apple from 180 per share on. It's currently trading at 178.44. The highlighted option says we get control of it at 180 for the next month. If we wanted to buy that option, if we look at the current value, 415 to 425, and I'll go through all of this with you, it would cost us $425 total. So think about that for a second. How much difference there is in our cost and our risk in terms of the shares. Again, if we bought Apple at 100 shares, then it would cost us a lot of money. At 178.44, that's $17,844 for 100 shares. Yet this call option only costs $425. Now you say, well, there obviously must be a catch, and there is. There are some risks to options which we're going to look to mitigate. We're going to look to reduce those risks and maximize the rewards. You can take what's good or bad about options and you can be on either side of it. So some traders say, well, I don't like that options have a decaying effect because they have an expiration. And I say, okay, well then be an option seller because you'll profit from the decay. Some traders say, well, I don't like how much stock costs. I'd rather buy, I'm good at picking direction, but it just ties up too much capital. The percentage returns aren't all that great. I'd say great. If you're great at picking direction and your directional strategies, use options. They're leveraged. They tie up a lot less capital. They're bigger percentage gains. In other words, there's something for every type of trader, every type of strategy. And that's part of the beauty of it. But they're not without risk. Everything has risk in the financial markets. I don't know of any market, though, where there's such consistency of profit potential. And when you get good, options are just a great way to build wealth and generate positive cash flow. So you are correct. We'll talk about the catches to options. But notice, with options, it's opened up the door to nearly any stock. Now you're not buying penny stocks and the stocks that, quite frankly, are probably not going to go up in value. You're able to participate in the upside or downside of the really great companies and really poor companies out there in the market today. Now, as we look at strike prices, I mentioned that there's a striking price, a deal price. Every option includes a strike price, and you get to choose exactly what you want to trade and when you want to trade it. So you can pull up whatever expiration you want. It can be a week away, it could be a month away, it could be a year away. You get to choose your expiration date. You also get to choose the deal price, and that's the price at which you'd have the rights or obligations to buy or sell the stock. You'll notice I've highlighted them. The strike price at for Apple 165, then 170, 175. You get to choose which one you want, and there would be some reasons behind which one would be right for certain strategies. Strike prices are in specific increments. Notice in the case of Apple, it has $5 increments between strike prices. The 165 strike, the 170. For other stocks, they could be closer or wider apart. A lot of that has to do with the volume of the stock, the price of the stock, and so forth. Now, SPY is the S&P 500. It is the most heavily traded asset in terms of equities out there because it's literally something that mirrors and tracks all 500 companies in the S&P 500. So it's very active. It gives you that instant liquidity, and you can trade it all day with stock or options. So notice in the case of SPY, it's so heavily traded, there's literally a strike price at every 50-cent increment. You can trade the 274 or the 274.50s or the 275s, 275.50s, and so forth. That's your strike price, and you can pick whichever one of those strike prices you want. So a lot of that has to do with your outlook on the stock. Where do you think the stock is going? Over what period of time? And you would match up your expectation with those options. So if I looked at this and I said, you know what, Apple at 178.44, I think it's going to 185. Well, then I could construct a trade where I could target the 185 level. And in a spread trade, I might buy the 180, sell the 185. Or I might just buy the 175 calls and then sell them when the stock gets to 185. There's a few different ways that you can do it, and there's some benefits and negatives to each strategy, of course, pros and cons, and you're just going to mirror, you're going to match up your expectation with your strategy. Pretty easy concept to understand there. Whatever you think is going to happen, you're going to put in that style of option trade. So the strike price is always listed for any option quote that you're looking at. For example, if we look at Apple, we can see the April 180 call right here. We can see it has a bid price. Look at the bid column, 415. Asking price, look at the ask price, 425. It has the amount of volume it traded today, the amount of open interest. We'll go through all of these points. You'll get into implied volatility and the delta of it. You can even see that it lost value. It went down in value today. Why? Well, remember, it's a derivative. The stock went down. When stocks go down, call options go down. If we looked at the puts, they would actually be in the green. They would show a positive change for the day because the stock going down would have caused the puts to go up in value. And you'll see those little intricacies. The strike price of this option that we were looking at was the 180 strike, and that means if you buy this call option, you've reserved the right. You've locked in the ability to buy 100 shares of Apple no matter where it goes for 180. Now, if the stock were to plummet in value and drop 170, 160, do you still have to buy it at 180? The answer, of course, is no. When you buy an option, you have the right but not the obligation. So we want to buy it at 80 only if the stock goes well above that. We want to buy it, you can kind of think of it as bragging rights. It's not really anything you can boast over that you can buy the stock at 180 if people can buy it for less than that in the open market right now. However, if this stock were to zoom higher to 190 or $200 per share and we still have the right to buy it down at 180? Is that something we can brag and boast about? Yes. We would never do that, of course, being our humble selves, but you could, right? And that's what we mean by intrinsic value and real value. If we have the right to buy it at 180, hopefully that stock goes higher and higher and higher, and that creates value for that call option. So buying and selling the option, that's what the bid and ask price show. The buyer, or the current highest bidder, is willing to pay $415. The seller, or the asking price, he's asking $425 to sell that call option. As a result, we have what's called a bid-ask spread. Now, there's a bid-ask spread in everything you trade. If you trade futures, there's a bid and an ask price for the futures contract. If you trade stock, there's a bid and an ask price for the stock, meaning buyers are at one price and sellers are at another. These prices are called NBBO. That's the National Best Bid and Offer. Now, this is a regulated market. It is regulated like stocks are and so forth, meaning you are seeing the highest buyer and the lowest seller. You're getting the best potential prices. However, if we place an order for this and we wanted to get in immediately, you have to pay the asking price, right, to get in immediately. In other words, if you send a market order, you're going to pay $425. If you send a market order to sell, you're going to sell at $415. You're going to get the worst of those two numbers. Now, we don't want to be firing market orders off, and you can always control your prices, which we definitely advocate. In other words, you don't have to pay $425. You could become the best bidder. You could put out a buy order at $420. You could split the bid-ask spread, as we call it. So you could say, you know what, highest bidder's at $415. I'll bid $420 for that option. And guess what? When you place that order, that bid will change to $420 because you became the best bid price. You'll actually see other people looking at the quote for that option. They'd now see $420 on the bid because that's your order. And it doesn't take much for a seller to say, hey, this guy went to $420. I want to sell. I'm going to sell to him at $420. And you meet in the middle. And in the middle of the bid-ask spread is really fair value when you think of it. You know, if the value of a home, it appraises at such and such a price, right? It's worth whatever buyers and sellers are willing to pay for it. But if you kind of think about it, or a car or whatever it is, the car dealer puts a sticker price, but that's not the true value. And then you might have the buyer that's trying to get a steal of a deal, but that's not the true value. The true value is kind of in the middle. And that's how it works with options. So if I look at this and I say, well, $415 bid, $425 ask, what's the fair value? Basically $420. That would be meeting in the middle right now, and that's what we call the midpoint of the spread. So get in the habit of haggling over those prices, especially getting in. If it's time to get out of a trade, I don't haggle that much because there's risk. If I don't get the order filled, I can lose money on my trade and so forth. But definitely getting in, you want to make sure you get a good price, because if you don't get filled, there's no harm done, right? You're not even in the trade. You can't lose anything. So with getting in especially, make sure you get your prices. An options premium is the amount you have to pay to buy the option. Just as with stocks, if you place a market order, then you're going to be buying at the ask price and selling at the bid. So you're going to get the worst of the two numbers. So looking at our Apple call option, we can see how much it would be going for, and we would have to pay for it if we buy that Apple April 180 call at an ask price of $425. If we were to just pay the asking price, quoted at $425, that's our price. Now remember, one option contract controls 100 shares of the stock. So you have to multiply whatever this option price quote is by 100, because we bought one contract controlling 100 shares. So that an option quoted at 4.25 is worth $425 per contract. The simple and easy way to think about this in your mind is if you just drop the decimal point. So if I go back to the prior screen and we look at these quotes, if you just drop the decimal point, you can see these options are going for buyer willing to pay $1,480 for that option. The seller's asking $1,500 for it. This one's going for $1,060 per contract. That one's they're asking $1,075. That's the seller. The buyer is willing to pay $695. The seller is asking $715. 415 by 425. $218 by $224. In other words, you get a quote, but this is per share and it's multiplied by the 100 shares. So every one contract, if you just drop the decimal point, that's how much it really is in dollar value. So in this case, buyers are willing to pay $415 for the option. Sellers are asking $425. And the good news is, as you go to place your order, of course, your confirmation page at your brokerage is going to tell you how much money you're paying. So if I place an order to buy this for $425, it's going to tell me, okay, you're buying one contract of this April Apple 180 call, and it's going to cost you $425 plus whatever my trading commission is. Hopefully you're with a brokerage that has very low trading commissions. It used to be, I've been trading for almost 20 years, and 20 years ago, I mean, back in the wild, wild west, as it were, we were paying, $2 per contract plus $10, $20 or higher ticket charges. It was expensive. Nowadays, you can trade in the options market where you pay a zero ticket charge, meaning you don't pay any commission that way. You only pay per contract traded, and it might be $1 per contract. So if I trade one contract of this April call in Apple, I pay $1 trading commission. That's the type of commissions we're dealing with today. So if you pull up at your broker and it's going to cost you $15 to buy just this one call option, you're paying too much, frankly. And there's better brokerages out there where you can pay a lot less than that, and that's important. The more money you don't spend in commissions, the more money you get to keep. An option becomes in the money when the price of the stock moves past the strike price of the option. The further the price of a stock moves above a given strike price, the deeper in the money the call option with that strike price will become. For puts, it would be the opposite. The stock would have to fall below the strike price. Okay? So let's think of it in terms of rights and associated with those options. When you buy a call option, you're locking in the right to be able to buy the stock. When you buy a put, you're locking in the right to be able to sell the stock. And those are two very, very different things. The right to buy and the right to sell. So calls give you the right to buy. I'm going to write a B here. And puts give you the right to sell. Now, when we think about that in terms of value, what do you want to do when you're a buyer? That's my question. And hopefully all of you say, well, I want to buy low. And what do you want to do when you're a seller? Right? That's my question. And hopefully all of you say, well, I want to sell high. You've heard the old Wall Street adage, buy low and sell high. That's how you make money in buying assets, right? I have to sell it for more than what I buy it for. So call options are in the money if they give you the ability to buy low. And put options are in the money if they give the ability to sell high. So think about it. Stock price going up above your strike price in a call. If I own a 50 strike call, let's just call this strike price 50. If this stock is going up, up, up above that, is my call option giving me the right to buy low? Yes, it is. It's giving me the right to buy down here at 50 and the stock's at 52, 54, 56, 58. The higher the stock goes, the more in the money my call option becomes. We call that intrinsic value. It has true intrinsic value, meaning if you can buy it at 50 and the stock's trading at 55, you have $5 of intrinsic real value in that option. Now, when we flip that around for puts, it changes things, right? Because with puts, we want the ability to be able to sell high. So if I bought the 50 strike puts, what do I want the stock to do? Well, I want it to go down. And if the price of the stock is going down like this, and I still have a locked in price to sell it at 50, my put option is in the money and it's gaining value as that stock falls to 48, 46, 44, 42, and the lower it goes, the more my put option is worth, because the further and further it moves in the money. And again, that's intrinsic value. If a stock's trading at 40 and I own the 50 strike put, I have $10 of intrinsic or real value. You can think of that a little bit like our real estate example where it's equity. If you have equity in a home, if I owe the bank $100,000 and my house is worth $200,000, I have $100,000 of equity. Well, we could call that intrinsic value. It's real value that you are worth. You get that value. It's value that you're guaranteed to be able to get if you sell it right that moment for that price. So if the stock is up at 60 per share, my 50 strike call has $10 of intrinsic value. And if the stock were down here at 40, well, the calls would be out of the money, but the puts would now have intrinsic value and be in the money. And so the put would be 10 points in the money if the stock were 10 points below my strike price. Now, as we think about that, if the price of Apple is at 178.44, any call option with a strike price below its current price would be an in-the-money option, because you'd have the right to buy the stock for less than its current price. So what are your in-the-money options? You can barely see the shading here on this particular option chain. Usually they'll shade in the money options, and it's kind of hard to see on this one, but it's these three strike prices. They're just slightly shaded in. Usually on the option chain it'll be more obvious which ones are in the money, and they'll be shaded in on your option chain. But notice it's just simply any call option with a strike price lower than the stock is in the money. The 165 calls are in the money, the 170 calls are in the money, the 175 calls are in the money. Well, how far are they in the money? Well, if the stock's at 178 and this is a 165 call, then that's 13 points in the money. Notice this is trading for more than 13 points of value because it has that 13 points of intrinsic value plus its extrinsic value, its time and volatility. We'll get to that later. What about the 170 call? Well, it's $8.44 in the money. So notice it's trading for above that $8 of intrinsic value. And what about the 175? Well, it's $3.44 in the money. So notice it's trading for more than that. Okay. Well, which options are considered out of the money? That's all the rest of these. They would actually call the 180 strike the at the money. That means it's the closest to the price of the stock. But all the rest of these are out of the money options. Why do they have value? Because they have potential. Because the stock could go up and go above them. So the further out of the money they are, though, the less they're worth. The lower the probability they'll ever be worth anything. And the reality is they're probably going to expire. They're further and further out of the money, and the stock's probably just frankly not going to get there. Okay? Puts are a little different. It just flips around. So now we'll change from looking at the call option chain to a put option chain. So now I'm looking at Apple's put options. And since you reserve the right to sell the stock at the strike price, we know that which puts are in the money? Well, any strike price that's above the price for the puts, right? Calls are in the money if the strike price is below the stock. Puts are in the money if the strike price is above the stock. So which ones are in the money? Well, the 180 all the way to the 200. These are all in the money, and you can barely see it, but they're shaded in, all of these strike prices. And that means the 175 and the 170 and the 165, they're out of the money right now. Now, it's possible the stock could fall below them and they could move in the money by expiration. There's nothing magical that happens when an option goes from being out of the money to in the money. In fact, it could happen, constantly. A stock could jump above it during the day, then below, then above it, then below. It's changing the value of the option a little bit, but there's nothing magical that happens. It's just simply we're looking at whether there's intrinsic value in the option. And you'll notice, take a 200 strike put. Somebody that owns the 200 strike put has the right to be able to sell the shares for 200. If you can sell the shares at 200 and it's only worth 178.44, that's in the money by almost $22. So notice it's $21 basically. Notice it's trading for that intrinsic value. And this one's trading for its intrinsic value plus a little of time value. And this one's trading for its intrinsic value because it's 12 points in the money, 190 versus 178, and that's how far it's worth. And this one's in the money by $7, well, 6 and change, and it's trading for more than 6. And this one's in the money by almost $2, and it's trading for more than that. And then all the rest of these are out of the money, but they still have some value because it's possible, they have potential that the stock could fall below those strike prices and the values could increase dramatically and they could gain intrinsic value and so on and so forth. But the further you go out of the money, the lower the value of the option because they just become less and less likely that the stock's actually going to get there and going to move to that price. So remember, with call options, the option is in the money if the strike price is below the stock. With put options, you're in the money if the strike price is above the price of the stock. An option's out of the money if it's on the other side of that. So for example, any call option with a strike price above the current stock price is out of the money because the stock hasn't exceeded that. It doesn't have any intrinsic value. If there's no bragging rights, then there's no in the money amount. There's no intrinsic value. There's no equity in it. It's kind of like, to use the real estate analogy, you owe more on your home than what it's worth. It doesn't exactly work that way, but it's basically you don't have any intrinsic value. You can't sell it right now and make a profit. Put options react differently in that they move the other way, right? So we know with put options, if the stock is below the strike, then they're in the money. Well, that means if the stock is above a put option strike price, then those puts that are down below are out of the money. So in the case of calls and puts, you can think of it just the opposite. With puts, you'd have to fall down to those lower strikes to get them in the money. Whereas with calls, you'd have to rise up to move those strike prices in the money. Let's do an example and make sure you understand the concept. Let's say we went out and we bought a 45 strike call. Now maybe, just maybe, you bought it when it was out of the money, right? So maybe you bought it when it was, right here at $43 per share. And you bought the 45 strike call. So you bought an out of the money option. Well, the stock went up to 45 and hit there a couple of times, which means it was an at the money option, but it just couldn't move in the money. It hit there and it'd kind of fall back, and then it hit there and fall back. Well, fell back again, and it's still out of the money. Stock's down here at 43. But then all of a sudden there's a turning point. Good news, whatever it is, and the stock blasts higher. Now, when it was at 45, it's called an at the money option. And as the stock keeps exploding higher, 46, 47, we say, okay, now that option is an in the money option, right? It gives us the right to buy at 45, and the stock's worth more than that. And the higher the stock price goes, the more that call option gains. And when it's up here at 50 and the stock's trading at 50, how far is your 45 strike call in the money? It's in the money by $5, and it would be trading for at least $5 plus any time value. Okay, so a call could be out of the money, move in the money. Sometimes an in-the-money option becomes out of the money. Stocks are moving, changing the value of the option, but that's how you consider whether they're in the money, at the money, out of the money, and so forth. Now with put options, maybe we buy the 60 strike put on a stock. We think that stock's going to fall and we want to profit from it. Well, stock's up here at 65. So currently that put option is out of the money. Doesn't have intrinsic value because the right to be able to sell at 60 is no good when you can sell for a higher price than that in the open market. Nobody wants to sell at 60 when it's selling for 65. However, stock starts to fall. It hits 60. Now we're at the money. We're getting somewhere. Stock really dives 55, 54, so on. Now our put option is deeply in the money. It's well in the money. Why? Because we have the right to sell at 60 and the stock is trading down there at 55. That put option, when it's trading at 55, would be worth at least $5 plus the extrinsic value, what we call time value. That's our Options Foundations Part 1. We're going to move into Options Foundation Part 2 now. We'll see you there. Goodbye, everyone.